Okay, guys, this is being recorded. One thing I say at the beginning of all these webinars, watch it again. I started out in college with a psychology degree, and if you watch something, it's just like in class. If you took a class and you went and reviewed your notes right afterwards, you're more likely to remember that material for a longer duration. If you learn the material and then you wait a couple of months down and you review that, it's almost like you're learning it all over again. What happens is if you review it very shortly after you've done it once, it sticks into your long-term memory, actually builds a little node, and you'll remember it more. So try and watch this again, especially if you're newer to options or this strategy in general. You may have learned this online, and that's fine. That's a good start. But they aren't going to teach you ways to increase your probabilities of success, all right? They're just going to give you the flat line. These are what you do with a particular strategy, but they aren't going to give you strike locations to help you out there, all right? Okay, so guys, JQ, I'll talk to you a second here. Hold on a second. I'm a little flustered because I got a little behind there. All right, so we're going to be using this for a bearish assumption. But let me get a couple of things out of the way real quick. My name's Eric Wilkinson. Some of you may recognize me from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Like I mentioned, I started trading in college, or actually I don't mention, I started out with a psychology degree in college and then started trading, switched it over to finance. And after graduating college with a finance degree, I moved to Chicago to work at the Board of Trade. The reason why I switched over to finance was because I started trading in college, and a buddy of mine said, hey, you would be perfect up in the pits. So that's what I did. It started out as a little runner, sold all my stocks and everything else, bought a badge, and started trading. So I've been trading my own money for about 25 years now. Please take a moment to read over this disclaimer. All this says, you guys, is I can't give you investment advice. And the reason why, and I wholeheartedly agree with that, because I don't know your risk parameters and I don't know what's in your portfolios. But what I am here to do is teach you how to trade options. With that being said, take that, implement it into your portfolio in your own way. And please remember that past performance of any trading system or methodology is not necessarily indicative of future results. All right. You can also follow me on Twitter at Wolfman's blog, or you can follow our parent company at ProTraderStrat. I see a couple of things. What was, they sell a big hard drive in full. I don't know what that means. A bigger hard drive? Mine is full. Do they sell a bigger hard drive? Are you talking about for your computer? You can get 2 terabyte SSD, which is solid state drives now, which are probably the best and fastest. Dust Storm and Dust Devil in Scottsdale. Yeah, we see those all the time. All right, did I answer your question? Oh, for my brain to remember. Yeah, it's not plug and play, is it? All right, so like I mentioned, this is on the long put diagonal. Now, if you guys watched last week's webinar, we did it on the long call diagonal. And we went through several different underlyings to try and find a good fit for all my rules. I will tell you, it is a little easier to fit all the rules with the long put diagonal because there's a lot of people will go out and pump premium into puts, and that's for protection. Basically what they're doing is they're buying protection for the downside, and that inflates premiums because there's a lot of buyers coming in for that. So puts have a skew to them that makes this strategy a little bit easier to put together. But with the long put diagonal, we are going to have a bearish assumption, like I mentioned, but it's slightly neutral here, very slightly. The only reason why it's slightly neutral, and I want you to kind of have that in your head that it's slightly neutral, is because we don't want a massive break immediately after we put on this strategy. We'd rather see a slow, like stair step down for at least that front month while we are front few days while we have this strategy on, so that our options can expire worthless or very close to worthless. But we want to be neutral but leaning or more bearish, but just a little bit neutral. I just want to have that thought in your head that I don't want this to happen immediately, because a lot of times when you're putting on a long put, you want that to go right now because of theta decay and things of that nature. With this one, we want that theta decay to happen in our front month and then take over our directional assumption towards the later half of that. Okay? Is everybody clear a concept so far on that? You just don't want a very fast move with this. We're directionally bearish, but it's not like we are thinking this company is going to go belly up tomorrow or something like that. All right. So where we start, I put this way. We buy the in the money put in the further expiration, and then we sell an out of the money put in the near expiration. And these are monthlies. Speaking with this particular one, the difference between a diagonal and a calendar is these are monthlies that are in consecutive order. So June, July, July, August, whereas a calendar would be like June Sep or June Dece. Okay, so that's the difference here between a diagonal and a calendar. A calendar, you are much longer term bearishness, and you will not be able to pay off all the extrinsic value in the first month. Whereas with the put diagonal, we're looking for a move to happen, you know, in the next couple of months is what we're looking at, next 50 to 60 days. And we also want to take advantage of volatility expanding in those months down the road. And I'm going to show you different ways to figure out how you know when volatility might or has a higher probability of expanding. But that's the idea here, is this is kind of a vol play in that back month where we want the volatility in that back month that we bought to have volatility expand, and we want the theta decay to eat away at this put that we sold, because this put we sell is actually going to help us pay for some of this put we buy. Okay, so although volatility isn't going to be a major factor in this at the onset, it can positively and negatively affect this strategy down the road. All right, and I'm going to get into more detail. I just want to get kind of the basics here, and when we pull up the platform, I think you guys will pick it up a little bit better. But what we do is we start with selling. I start with selling the out of the money put. The reason why I wrote it this way is because that's how it's quoted. But what I do is I start with the out of the money put, because that's where, you know, I'm worried about my risk in a sense to the downside. I don't want this out of the money put to go into the money in the next 1 or 2 days. I don't mind if it hits there in about 2 or 3 weeks or 2 weeks, because then I will be able to be very close to my profit potential. But we're going to start to sell this one, see how much money we can get for this out of the money put, and then we use that money to finance some of this in the money put. And the part we're trying to finance on this in the money put is that part that decays, right? An in the money put has intrinsic and extrinsic value. An out of the money put only has extrinsic value. All right. So what's the difference between intrinsic and extrinsic? Think of it this way. Intrinsic is internal. It's like what it's worth. It's the real nuts and bolts. The extrinsic is kind of like air. You know, it is theta decay. It will come off over time. And this is all extrinsic value. So if we can take this extrinsic value and pay for the extrinsic value here, then we own this put for what it's really worth. Okay. John's asking, is the long put diagonal similar to the short put butterfly, both looking for volatility expansion? We are looking for volatility expansion, correct. But with the put diagonal, you know, it's a little bit different because we are one directional on this. All right. definitely going down with this one is what we're looking for. In the put diagonal, we could, or in the put butterfly, we can go in either direction. Essentials to success. Picking the right environment. What's picking the right environment? The right environment here. Usually I talk about doing strategies with high implied volatility, low implied volatility, and fit those rules. Really, you can do this strategy in just about any environment where it's high or low. I use this strategy usually when implied volatility percent is somewhere between 50 and 30 on a stock. And implied volatility percent isn't this what I'm talking about. That's the volatility. But what I'm talking about here is this current implied volatility percent. I say less than 50, but the sweet spot seems to really be around 30 because we are looking for volatility to expand. So if you start out with really high implied volatility, it's hard to get it to go even higher. The idea is if we can play volatility when it's low, it's going to have a tendency to revert back to the mean. So for instance, when it's way down here, it's going to want to come back to about the mid-level, right? And I don't mind if you put it on around 50, as long as you're expecting this volatility to come out of it. Now, Costco has the earnings today, and I accidentally missed the opportunity to trade that one today. I got a little bit busy getting ready for this. So no earnings trade for the daily market commentary tomorrow, unfortunately. But what we want is volatility to expand, not contract. And right now, we know after this binary event, volatility is going to contract. But generally, heading into a earnings, it does something like this where it will slowly increase. And then you get that volatility crush after all the news is out. But we want to take advantage of volatility increasing in that back month. And one of the best ways to do that is to try and put that long put that you bought in around an earnings or a binary event. A binary event can be anything from for treasuries, an FOMC meeting. Okay, that's a binary event that affects specifically those asset classes. For a stock, it's usually a earnings event. On medical companies or drug makers, when they have a trial release or the trial results released, that is a binary event because that is usually a 2 or 3 year long process and people are waiting for that drug to either get accepted or denied or, whether or not it is a good drug or it didn't work. Those result releases are what's going to drive that particular stock. So volatility will expand on something like that as well. So the sweet spot is somewhere below 50. I like it below 50. 30s is a real good spot for implied volatility percent. The major thing I want you guys to look at, though, is if we are doing the July to the August, let's say, we do not want more than 3 percentage point difference between these two numbers over here on the side. And that's just volatility. The reason why, and this is kind of a bad example, this is backwardation. This is what we would want. We want this one to be higher if that is like the best case scenario. That's the diamond in the rough. If you find volatility in the one you're selling higher than the volatility of the one you're buying without a binary event in it, you guys, this has a binary event, so it's giving me this example. That is good because the one we're selling has high implied volatility, higher volatility than the one we're buying. So we're getting paid more for the one we're selling and paying less for the one we're buying. And that is based on volatility, guys. Obviously, the one we're buying is going to be more expensive, but what happens is that you're paying less for that volatility coefficient, if you will, than the one you're selling. Does that make sense, you guys? If you can sell higher volatility and buy lower volatility, you're kind of doing a vol play, and that's really what this is about. So that would be a perfect case scenario if there wasn't an earnings event coming up today for the most part. All right, so we want something like this backwardation. If you guys ever heard of backwardation back in contango, backwardation means backward down. Backward, the further out in duration is lower than the current. All right. Normal markets, generally speaking, will have contango where the further duration is higher than where we are currently trading. All right. But this is an example of backwardation, backward lower, so backward down. And that's what we really want. On something else, anything else, Aeon's a bad example. I don't want to do Aeon. Anything else, we want it to be within 3. So you can see here, we're going to be playing in the July and August. This is too much of a difference. I'm going to be selling really low volatility and buying high volatility. The difference here, we want to be less than 3%. And this one's at a little over 4. So that would make it like a yellow light. I talk about red light, green light, or green light, yellow light, red light. This is like a yellow light. You know, you get like 5, 6, 7. That starts becoming a red light. And I would not do it. So green light is less than 3% difference from contango. If it is in backwardation where this is higher than this, it is a full-on green light for this particular rule to succeed, okay? Picking the right environment. Less than 3 percentage points difference between those option contracts in the montage. Now, this is all a montage. All of these things, it's option montage. So this is too far away, all right, to meet that rule. 4 points, too far, that makes it yellow. Green light is what, especially if you're a newer trader, stick with all green lights, okay, in the beginning. Because if you start going to yellow lights, red lights, what red lights don't do, but yellow lights, that's kind of like, all right, you know, I'm increasing my risk, all right? Just know that if you're going into a yellow light anywhere, you're increasing your risk and likely lowering your probabilities of success. All right, picking the right underlying. Back to the option montage. And one of the reasons why I didn't want to pick Aeon is because Aeon doesn't fit this. Aeon's too wide, but I watch Aeon. And it doesn't mean that just because a stock is popular and out in the public and everybody knows about it, like Aeon, that doesn't mean that people like to trade it, all right? The way to know if people like to trade it is you look at the option montage, and usually to fit this rule, I go to the nearest to expiration monthly and look at it. A stock under $100, the options that are just out of the money, the puts or the calls, need to be within 10 cents from the bid to the ask. These are 3 cents. It's under $100. That's a good stock. Stock that's over $100, you move the decimal 3 ticks to the left, and that's how wide it should be. In this case, it would be 10 cents still, but you can see it fits that rule. $1,000 stock, Google, you're going to move it 3 ticks to the left, and they should be inside of $1.10. They are a little wide right now, but Google usually fits that rule as well during the day. For instance, let's look at Bank of America, or Boeing, sorry. Bank of America is an example I was going to use today. 3 ticks to the left, 35 cents wide. You can see that fits these rules. All right. So that's the idea. Under $100, 10 cents wide for picking the right underlying. I'm not going to trade stocks that don't fit this rule, you guys. And you'll see, you might be able to pick out 1 or 2 like that Aeon one, but 1 or 2, and it's just because it's stocks I like to follow. But go with that rule, especially if you're a newer trader. Green light is fitting those rules. Anything outside of those rules is starting to be a yellow light, all right? Which means you're increasing your risk because you've got to give up edge to get in and get out when they're too wide. And think about it. If this only decays, if these were super wide and I had to give up 25 cents to one side, well, it's going to take a long time for me to get back to even on that, all right? So you have to give up edge to get in and edge to get out because there's only like a few people in here making markets, and they're like, hey, you know, I'm the only dog in the park, you know. You got to come to me and play. So if it's something like Apple where everybody's in there trading, it's like if I see my market, if my bid goes off the market, I'm more likely to move that up and join the bid or even make it a penny better. And that's what free market price discovery is, you guys, is when there's a lot of participation, is that market gets tighter and tighter and tighter because you might be willing to give up a penny to get the fill and things of that nature. And so is somebody else. So tight bid ask is essential, especially if you're a newer trader. All right. Then the right duration. We're also not only doing a volatility play here, we're also doing a theta play here, because this is, now we can argue back and forth. Okay, this is a curve that shows theta decay. Now, and it's for the at the monies, right? We're not necessarily dealing with the at the monies, and this curve is going to be a little bit different, okay? But what I want to show you with this picture is options further out in time decay much slower than the ones that are inside of 35 days. So the idea here is that we want to sell the option that decays faster, which is this one. We want to sell this option and we want to buy this option, like out here, because this is going to decay faster. That allows us to just ride this put, that is this long put, out. You know, it allows us to get that directional move. And this, if it decays really fast, obviously gets us out of the extrinsic value we talked about. And then the put is worth what it is. So we don't necessarily, we're taking out some of this component in a sense because we paid off the theta decay by buying or by selling this option against this one. We paid off the theta decay. So we don't necessarily have to worry about that, right? Well, we kind of do, because this one's decaying faster. And we want that to happen. We want this to decay as fast as possible. And then that's another reason why we want that volatility to come out, because it helps this front one decay faster, right? So bottom line is, when we were talking about buying that out of the money, or sorry, buying that in the money option, further duration, we want it out here, 75 days-ish. And then the one that we are selling somewhere 45 to 35 days to expiration is really the sweet spot to get in early. You've got enough premium to get it further away from the market, and then you get into it and you start seeing this happen, which is what we want, okay? And then once this decays, we see the volatility pump up the premiums here, okay? All right. I think everybody's got that so far. Picking the right strikes. Now, I touched on this a minute ago. What we are looking for is we're going to start out with that out of the money option that's near expiration. We're going to be starting around a 16 delta. That's where we want to start to sell it. The reason why we want to sell it around a 16 delta is because our probabilities, our bang for our buck is the best at around that level. We're going to be able to get somewhere between 30 and 50 cents at that 16 delta. 16 to 18 is really where we're looking. So we're going to try and get about 30 some odd cents to 50 cents for that trade. That's going to pay for the extrinsic value of the option we buy at around an 85 delta. So we're looking to buy an in the money option around an 85 delta and sell an out of the money option at around a 16 delta. Okay, and that will help us pay off that extrinsic value. Is everybody with me so far? Can you please talk about the direction in which you want, or in the direction you would use a put diagonal? We are bearish in the put diagonal. All right. All right. So picking the right strikes, we're going to start around that 16 delta that we sell in the near expiration. and then see how much money we have to finance that extrinsic value, right? One thing with this strategy I want to mention, after we built this out, we want to pay less than 75% the width of the strikes. So if it's $10 wide, we don't want to pay any more than $7.50 for this. And I'm going to show you guys an example. Actually, I don't have an example of that, but you could see it where you are paying $10 and 1 cent for a $10 wide spread. That means there is zero possibility of making money. All right. If you pay more than the width of the strikes, you have locked in a loss, that penny loss. All right. So we don't want to pay more than 75% the width of the strikes. So on a $10 wide, that means we don't want to pay more than $7.50. That means our profit is $2.25, our max profit, right? Don't pay more. But if you take anything away from this, do not pay more than 75% the width of the strikes on a put diagonal. And just know that if you went out and looked online how to do a put diagonal, all they're going to tell you is buy the further duration, sell the near duration, make a spread, and good luck. They aren't going to tell you, because they don't know, that there is a situation where you could put yourself into where you locked in a loss. Don't do that. Very important with the put diagonal. Do the math, figure it out, make sure you're not paying more than 75% the width of the strikes. Okay? Is that clear for everybody? Sell an in the money option. No, sorry. Sell an, John, I may have misspoken. I hope I didn't. You want to sell the out of the money, near duration, 16 delta option, and you want to buy the in the money, long duration, 84 delta put. Does that make sense? Is everybody clear on that? All right, so knowing your exit strategy before entering the trade. And I probably beat a dead horse on this one. Write this down, you guys. It is the best way to stay mechanical. If you have it in your brain where you're going to get out, you're going to get to that point and you're not going to get out, more than likely. Stay mechanical. Write it down. If you write it down on a piece of paper, why you got into the trade, what you paid for the trade, what your profit target is, when you're going to get out. I have a buddy that does a time stop. He's like, this doesn't start happening. If I don't start making money in the certain amount of days, I'm out of it. And you can do that too. I don't ride that way. I like to let the probabilities play out, but you can do it that way. But write it down. If you were going to do that, all right, if I'm in this trade for 5 days and it's not working out, then I'm out. Or my rule here is we're going to take 50% of the max profit potential. All right, write that down when you do it. Write down the number. So if we paid $7.50 in my example I've been given on a $10 wide, our max profit is $2.50. So we're taking 50% of that. What does that equal? $1.25. So when this strategy has increased in value from the $7.50 where I bought it to that extra $1.25, which is 50% of my max profit, when this strategy is trading $8.75, that's when I'm out. And I write that down, because if I write it down, I'm going to see it and I'm going to know it and I'm going to get out. Okay. And you don't have to keep doing the math every single day to see if you're there, but write it down. Why not put a GTC close order? Banu, that is definitely a good mechanical strategy to do. I don't like my order book filled up with tons of GTCs. But when it starts getting close, I do put in those GTCs. Say, for instance, if it was at $8 or $8.20, it increased from $7.50 to $8.25, and I'm looking for that extra 50 cents and I don't want to miss it when it hits, then that's usually when I put it in, when they start getting closer. You know, I don't want to go in there and offset it because I've changed my mind or my directional assumptions change and stuff like that, and I have orders still in there. So I like to, once it starts getting close, start implementing that part of the mechanical process of putting orders in as GTCs. I usually wait for them to get a little bit closer. As a matter of fact, I put in a couple of GTCs today on a couple of trades that I've talked about in the daily market commentaries because they are getting close. I think one was a nickel away and one was like 2 cents and I didn't get it, but you know, I'm starting to put those in because they're getting close. All right, everybody clear a concept? 50% of max profit potential. So in my example, when it increases from $7.50 to $8.75, that's where I get out. I'm leaving the rest on the table. I don't care about it. Okay. All right. So I've gone over this a little bit. Max profit is the width of the strikes minus the net debit. Now keep in mind, with differing expiration cycles, max profit can change, right? Our max profit is based on the time of inception here. Because if that short put expires worthless, what are we left with? That long put. And that long put has potential to make us more money than what our original width of the strikes were, right? So the profit potential can vary based on, one, volatility changing. Two, it can also change based on the way that these options expire. Your max loss, though, is always the debit you paid. Anytime you pay a debit for a spread, that is the max you can lose. And in this case, ours would have been $7.50. Now, our break even, again, will change based on volatility and everything else. But it's at the inception, it's the long put strike minus the debit paid. So our in the money put minus the debit paid is where our break even is. And the beauty in the put diagonal, it makes it a lot easier to have our break even above where the underlying is trading. So you can be a little bit directionally wrong and still not reach your break even. Okay, so that's another key aspect of this. And if you pay for all of the intrinsic value, if you pay for all of the extrinsic value at the inception and maybe even a little bit more of the intrinsic value, what it's really worth, that's how you get that break even above, because you paid into the intrinsic value and paid off some of what that value really is. Does that make sense? Besides the 75%, what else would make you decide not to use the diagonal, the put diagonal? If I had to pay more than 75% the width of the strikes, I'm out. If the volatility, if I pay too much volatility in that back month, like I mentioned with the environment, if it's over 3%, I'm not going to do it. If there's a 3% difference, I'm out. If the bid ask in the option montage, you know, on a stock that's under $100 is 25 cents wide, I'm not going to do it because it's too hard to get in and too hard to get out. I have to wait for somebody to come to me, or I have to give up way too much edge to get there. Can you clarify the break even again? It's tricky to understand yes, I will. It is tricky to understand. It's easy to, why is it always easier to add than subtract? I'm in that boat. I have to subtract from long put. I have to pull out a calculator a lot of times, but you add it, it's so easy. But I will go over that here in a minute. Long put minus that debit paid. So for instance, if we had a $10 wide strike, say the strikes were the 100 strike and the 110 strike, $10 wide, we paid $7.50. All right. The 110s, the 110 puts minus the $7.50 would mean our break even would be at $102.50. But I'll go, when we pull up right now, here it comes. The platform, the fun part of it. Actually, this is the part of the webinar where I throw it out to you guys in the chat window, how we've been communicating. Give me some examples or some stocks, ETFs work as well on this. You can do this in a margin or in an IRA. So it is my IRA appropriate. But throw some stocks out there while I go over a couple of these questions real quick. The break even, I'll go over here in a second. And I think I got, if I miss one of your questions, because these are people are flying up with questions and stuff like that, throw it out there again if I didn't run across it. How about Momo? All right, we can try Momo. Well, they make motorcycle helmets, right? Is that the motorcycle? I know there's a company that is named Momo that makes helmets. All right, one thing is we're not getting that August, which makes it a little bit more difficult. It's going to end up being more like a calendar. But let's look and see if it fits the rules. It's 20 cents wide, and it's a $40 stock. That's a red flag for me. No, it's, yeah, but they do make helmets though, right? Or is that something else? But 20 cents wide, I mean, maybe during the day, are these a little bit tighter? You could look at it. But they don't have the August. I'd really rather have the August in this for this. You know, this would work with a calendar spread. But if we do this, we aren't going to be able to pay off the extrinsic value of the option we buy in the money. Because we're going to be, let's just say we went with an 80 delta dollar. I got to sell an option. This is a floor trader shortcut, you guys. If you look at the option that is in the money, we talked about intrinsic and extrinsic value. This 60 put option has value because it's worth something. It's in the money. It means, you know, there's $14 of intrinsic value in here, right? From 60 to 45, that's $15. Is that right? 60 to 40, yeah, 14 something, right? Well, that means this is like from 1470 to 1520, right? So this is saying $15. Well, how much extrinsic value is there? Well, a real quick way to do it is look straight over to the corresponding calls, and that tells you how much extrinsic value is there. It's off by a little bit, okay? I'm not going to tell you it's coming down to the penny. It's not even going to come down to the nickel. It may not even come down to 10 cents sometimes, the bigger the stocks are. But it's going to be close enough that you don't have to get a new hard drive for your brain to do all this math. You know, I'm trying to dumb it down for you. And on the floor, we had to think on our feet. We had to be fast. You know, person that gave the first quote was usually the person that got the order. So there's all kinds of shortcuts that we would use. And we wouldn't really be worried about the nickel, right? If I got the trade, I'm not really worried about the nickel if I'm the first guy in. But that's a little floor trader hack or shortcut. Look straight over to the corresponding calls and the puts. If you're looking at the calls in the money, you can look at the puts for the corresponding, all right? But yes, they are okay during the regular session. All right, I'll take a look at it another time too. But if we were going to do this, I think it's a little bit wide. And that's another thing. If these out of the money, just out of the money options are getting wide, when you start getting further in the money, options always get wider. So it's going to get exacerbated. All right. It's going to be almost twice as much usually. The other thing, this does fit the rule of the difference. You know, it's 1 percentage point difference for the most part. That makes that a green light inside of that. The only thing that would make me a little iffy is the wide bid ask on this. And I don't really like the fact that I don't have the August options there. All right, so let's look at another one. Let's check out Tesla. All right, now also full disclosure, we may talk about options or underlyings that I have open interest in, whether it be stock or options. I'm not trying to get you guys to let me off the cliff with me. It is just for educational purposes. All right. I'm not trying to pump and dump stocks. I don't do that. If you do the stock that I do, then that's on you guys, right? All right. So we're going to be looking for that 84-ish delta. That's getting pretty deep in the money, making it pretty hefty. So I'm going to go and try and look at the 80 delta because I got to get $4.85 or $4.75. So I'm going to look to buy that one. So I need to know, I'm going into this knowing, all right, I got to probably do $4.80 or something like that. So it's going to kind of be a pick in between these. Remember, I said it's going to end up being that 84 delta to the 16 delta. You know, that's a product of options as well that I don't really want to get into right now. But I'm going to lean towards a little bit closer on this one just to make sure I get that difference. One thing I didn't know, it's 5 points difference. That's one thing I should have checked right off the bat. That's a little bit wide. Now I'm paying a lot for this one and not getting a lot for the one I'm selling. So because it's 5 points wide, if it was like 3.5, I'd probably go with it. But now that I see that's a little too wide, I'm going to skip it. One thing I also wanted to mention with this one, and the reason why, well, that doesn't make sense. It should be, it's because this binary event's in there and it's jacking it up, but you'd think it would help out this one a little bit more, but it's a little too wide. One thing we do want though is that long put. It was a good example, Colleen, is that if our put lands that we're buying here, we get that volatility expansion, which is what we want. So, you know, perfect scenario would be to get that volatility expansion in the one we bought while this one's decaying. And so that's set up nicely that way. That's one way to know that we're going to get volatility expansion. It always, I would say 99% of the time, you know, and that's, you know, totally a made up statistic. But a lot of times volatility is going to expand heading into that binary event. All right. So if we got our long put in that binary event, that's good. Do not hold it till after the binary event unless you are almost at like a full loser on this, okay? Then I would go into the binary event because you almost have nothing to lose. But if I was profitable or basically at a scratch heading into this binary event, I would get out because volatility crush, which is this, when the volatility comes out very rapidly, which is why we call it a crush. It feels like, if you guys saw the picture of the Pompeii guy, that's what it feels like, is that rock falling on your head. That is volatility crush, and your skull will get crushed. Even if you're directionally right, you could be directionally right and still lose money based on volatility crush, you guys. So get out of it early, especially if you are at a break even or a profit. Even if it's just a little profit, I would get out. If you're at almost a full loss on it, then you've got nothing to lose. Write it out. Okay. Sorry, we couldn't do Tesla. I know, because I mean, I got a 2-year put on Tesla just for full disclosure. I'm bearish Tesla. I wish it would work out for this one because it would be a good one. You know, and if you choose to do it, just know that you've increased your probability or decreased your probabilities, increased your risk, all right, on that one. One thing to note is it's $100 wide. You're only paying $60. So in that regard, it fits that 75% rule. The one thing that it doesn't is fit the rule of the wide difference here. So all of the other rules are fitting with this, except for that one. You know, if you were really pretty bearish on Tesla, then, you know, just know that you got that yellow light in there. I'd be a little bit more trigger happy to get out in that regard, okay? So if you ever have those yellow lights, you don't have to always go to 50% of max profit on this. Maybe you're going to like 30% of max profit because you're a little bit iffy on it, you know? Pompeii guy, is that a rescue at the recovery? No, there was you guys, Pompeii, or is it, wasn't it Pompeii? The volcanic explosion, you know, at like 75 AD or something like that. They found some guy that got hit by a big boulder that got blown off the top of a volcano, and it landed right on his head. Oh, you saw that one. You're giving me a hard time. All right, so let me do a couple other ones here. One thing I do want to show real quick was that is that backwardation in a real scenario. And not to say that I want to do Bank of America, but no, that's got this stock, and that's got the thing. But backwardation, again, is when this is higher than this one. That's backward down. So that's an example of backward down. And you will get that without the binary event in there sometimes. So keep your eyes out for that. All right, so another one was Verizon. Somebody's hating on Starbucks too. So we'll do that one next. All right, so 45 to 75 days to expiration, that's kind of our wheelhouse on that. We're a little outside of that, but it's the closest to that we can do. You can use, especially in really popular stocks, the weeklies. I usually start out with the monthlies and then I'll roll into the weeklies, but I usually start out with the monthlies, all right, because that gets you a wider spread. You start out with the weeklies, you might not be able to get that. I mean, in this case, selling this July one might work out for you. But you can do that. I'm not opposed to it. Just make sure there's still tight bid asks in there. All right, so we're going to look at doing something like starting out at around the 84 delta. But 20 cents, that's not a whole lot to pay off. I think I can do a little bit better. So let's start off, and the rule of thumb, we're starting out with that 84 delta, right? Always move closer to at the money on both of these. Even the ones we're selling, try and move closer to at the money if you can, because that, you'll get more premium this way, and you got better probabilities going this way, and you don't have to pay as much. So let's start out with the 50, because I think I can at least get that 60 cents, and then the 60 cents, I'm not going to be able to do that now. So let's start out with the 52 and a halves and go with the 44 and a halves, 20 cents. Got to at least collect 20 cents, so let's go with that one. All right, so we have a $8.50 wide spread, right? 44 to 52 and a half is $8.50. So unless you can do the math in your head, which I'm not going to be able to late in the day after doing stuff like this all day. So it's 8.5, I said. So we take what we paid, $5.22, divide that by the $8.50, and that gives us 61%. So that's inside of our 50 or 75% the width, right? That's lower. That means we're risking less to make more. So that being said, that fits the rule. We know that it fits the rule on the bid asks. Does it fit the rule on, yes, it's within 3 percentage points. It's actually, a half a percentage point. So that's good. We're good there. Binary event happening just outside of this, but I'm good with it. If you guys are, it doesn't necessarily mean volatility is going to expand, but look how low our volatility is right now. We would expect if volatility is down here where it's been before, what happens? It's going to revert back to the mean where it spends most of its time. So it's going to go there, and then it's probably going to spike up higher, but we want it just to start increasing a little bit for us. All right. Why did you not decide to do Tesla even though you had a few greens? I just had that one yellow, and I wouldn't want to, I'm trying to make sure that I'm giving examples for newer traders and stuff like that. If you've been trading options and you're comfortable with having one yellow light in there, I would say that would be probably the max I would go with is one yellow light. So Tesla, I would do it if I was bearish on Tesla. Had I not already had the long duration put, you could do that. I'm not saying it's a deal breaker. I'm just saying that if you do have that kind of scenario, maybe take a little bit less than that 50% of max profit because you've got that yellow light in there. Does that make sense, John, and everybody else that may have had that same question? Okay. So yeah, you can, but I just want to make sure we try and find some examples that I will probably implement tomorrow. So usually when I do these webinars, the next day I implement one or two of these strategies that we've talked about with you guys. All right. I don't like to put them on beforehand. It's not to say that I haven't done it because I can't pass up the opportunity, right? I got to make money too. But just, I like to do it after the webinars, the day after, so everybody has a chance. So everybody knows that I'm not trying to pump and dump it. All right. Because I don't want to be that guy. So Verizon, bearishness just comes outside of it. So, that's another one of those yellow lights. But this one I might be able to deal with because the implied volatility is so low that I've got to think, well, if it stays down here, really, how much lower can it go? It's not going to contract that much to necessarily hurt me. Yes, it can go below where the low has been. I'm not saying that can't happen. Yes, it can. And it can go higher than where it has been before. But the idea is that it is not going to go much lower, especially when you see all these. It's kind of like support and resistance on stocks. You can see where they come down and bounce off several times. That's usually the low area. And this is the same thing with this chart. All right, so it's going to want to revert back. So, that works for me. We got all of that with the less than 50% of the max profit. Now, here's what we were talking about, break even. You take the one that we bought, which is this 52.5 minus the $5.22. So who comes up with it faster? It comes out to $47.28. Did I do that right in my head? Yes. Right? So that's our break even. So $47 and what did I say again? $47.78. $47.78 is our break even. That puts us just slightly above where the underlying is trading. So our break even is slightly higher. That's good. Right? You want volatility expand and drive the underlying down, right? This is the long put diagonal. So yes, a lot of times as the market goes down, volatility does expand. So that is also another benefit of the long put diagonal. With calls, usually when the market goes up, volatility wants to come down. So, but with volatility expansion, that usually will help us in the puts. Which is why, if you watched last Thursday's webinar, you guys were seeing that I was going through a couple of different examples. I mean, you can almost throw darts at the watch list and get this strategy to work with the puts. All right. But, and even more so if you're paying over 75% the width of the spread with the puts, you are really setting yourself up for a world of hurt. So knowing that my break even is above where the underlying is trading, I know I paid off all of the extrinsic value. Okay. That's another check off. The reason why is because if I am above where the underlying is trading, that means I've eaten in, by selling this option, I've eaten into some of the intrinsic value, what it's worth. Okay. All right. Disney is the next one. And of course I have options in Disney. And I've talked about those in the daily market commentary, so it's nothing new. All right. So I'm going to start out around the 84 delta. Look over here, 18 cents. I think I can do better than that. So I'm going to go a little bit tighter. I think I can go to about, I'm going to go to around this one because it's 65 cents. So I'm kind of looking over here. I'm not even really looking at the prices over here. I'm looking over here to see where I got to be able to make it up over here. So this is the one I'm going to look to buy. Bang, look to sell. 8.5. So 8.5, $18.50 wide. So we have an $18.50 wide strategy. You know, one thing I forgot to check. Make sure you go through all those steps. It's inside of the 3% rule, 3% difference. That's good. Bid ask is tight. That's good. It's inside of 10 cents on a $100 stock. That's good. We are now looking at an $18.50 strategy with $11.25 paying out, right? 18.20 or 11.25. So 11.25 divided by that $18.50 wide spread to determine how much we're paying. We're paying only 60% of it, so that's good. 17 and a half. Wim, 17 and a half. I don't know what we're talking about there with just 17.5. All right. So then the next thing would be to subtract out this $11.25 from the 110 puts, right? Those are the ones we bought. That's to figure out our break even. 110 minus the 11.25 gives us, and I can't do that one right now, just minus the 11.25, and if I wasn't typing this, I could probably do it in my head, $98.78. So our break even on this one is below where we are trading, right? So we didn't pay off all the extrinsic value by a nice little margin there. So that's one of those situations where, you know, if the break even's below you, you didn't pay all the extrinsic off. So then I'd probably go with that spread there. Go a little bit tighter just to see, $15 wide, $10 and 70 some cents. Let's just see if it gets a little bit better. First check the $10 and 73 cents to make sure we are still within our parameters, divided by the $15 wide spread, 71. Okay, so we're still within the parameters there. Now we take the 110 strike minus the 1073, so we got 99.25. That's a little bit better. It's just slightly lower than where we are, and something like Disney can make that up in a heartbeat. So that being said, that would probably be the one that I would work. You know, the yellow light being, all right, well, it's a yellow light. It's below. My break even is below where we're trading, so I have to make up some ground to get to my break even. That makes that the yellow light. I am not already making money, right? When it's above, we're already in the money on our trade. But if it's below, then we got a little bit of work to make up, all right? So that would make that part of it a yellow light. All right, and in this case, we would have the volatility expanding in that back month, so that's a good one. All right, last one was Starbucks, and then I'm gonna take some more questions. Hold on, but give me 1 second. All right, so low implied volatility. We got the earnings happening in that August expiration. This is a clean month, so that's pretty good. Not been a whole lot of great news coming out of Starbucks, right? I mean, the jokes are that it is the world's largest public bathroom now. So, you know, that might not do so well for their sales and definitely not their margin. So August to July is what we're going to be looking for. Let's look at the difference here. It's 2 percentage points, slightly less than 2 percentage points. All right. It's a $50 stock, so these need to be inside of 10 cents wide, which they are. All right, we're good there. Let's look at right around that 80 some odd delta that we were looking at. I'm going to stick with this one because it's 30 cents is why. So I need to look for 30 cents to pay off for it. who's going to give me 30 cents. These guys are not. Why not? It's close. I'm going to go with it because I don't want to go that. I don't want to go this close to at the money. I want to be a little further away. So we have a $10 wide spread. It should be easy for everybody to do the math, right? 60% almost. So that fits that rule. We're good there. $10 wide, paying about 60% the width of the strikes. Our break even, we need to take the, let's just take $6 off of this, and that puts us at 50, what are taking $6 off? $58 and, no, $56.50, sorry. So $56.50. It's slightly lower. Our break even slightly lower where the underlying is trading, but I knew that going into it, right? I knew, all right, I'm probably not going to pay off the extrinsic value, all right? So I knew that getting into it. I'm pretty good with that because I'm pretty bearish on Starbucks, all right? So that yellow light I might go with for a couple of pennies, right? We can, I was going to show the Analyze tab, but the Analyze tab, I don't know if it's going to show it very well. Let's just take a look at it on the Analyze tab. You know, they say a good lawyer never asks a question they don't know the answer to, and I haven't looked at the, see how it bends here. It's not giving you like a really good indication because everything could be different. So, but you know one thing, that your risk is that $6, all right? Why did it switch over to a credit? Oh, I did it as a credit. Sorry, I did it one too many times. Sorry, your risk is the, all right, I'm not going to do that. I don't know what just happened all over here. And it's not going to give you the exact what you're used to on that Analyze tab because there's so many different variations with the volatility and things of that nature. So it doesn't really show up very well. What is the rationale to have the yellow light when the break even is less than where the underlying is? Well, if the break even is below where I'm at, I've already, you know, I'm not at my break even, right? I mean, it means you're kind of losing money in a sense at that point. I'm only losing a couple of pennies here or there, but more so trying to make the point that if you do this, set it up really well, your break even can be like 50 cents above where you are. So that means you could be directionally wrong for a little bit before you even ever reach that break even, okay? Whereas if our break even's below us, we're a little bit wrong already on our directional move. We got to get that little bit of move down in order to be profitable in a sense, you know, quote unquote profitable. It's not something to keep you up at night, but it's something to just keep in mind while you're doing it to make sure that you're sticking close to the rules. You know, the further away you get, John, I see your, I got it now, Eric. All right, but somebody else may not. So I just want to make sure. I appreciate everybody's questions because you may not be the only one with that same question. All right, so, all right, the idea is just, you know, increase your chances of success by getting that break even above. With this one, if you're looking at like, hey, you know, I'm pretty bearish on it. It's only a couple pennies. You know, it's a yellow light. I do have to make up that ground, but you know, that's something I'm going into it knowing. All right. All right. Does anybody else have any other questions? Because that's pretty much it in a nutshell. Now you can set this up like to be a full loser. And I had an example. I can't remember where I wrote it down. Oh, here it is. Let's look at one last one. This is a bad final example of what not to do because I want to make sure you guys go away with this. For instance, you know, and when I'm talking about those 45 days, the 75 days, you can go online. They're going to say, you sell the near term. Okay, so let's go sell the near term and buy, let's do the June, July. All right. And, oh, that's not the right stock. I didn't write it down right. Ooh, $200 stock. What was it? Oh, I can't remember what it was. Shoot. I didn't write down the right stock. Sorry, guys. I can't remember what the bad stock was. Basically, it was, let me just tell you, it was the June, July, it was the 200 strike with the 195 put, and I was paying it was looking like I needed to pay $4.65. So that was a really bad example of something. The stock was trading right around 200 or something too. So it was, maybe it was Costco. I don't know if I don't think it was this. It wasn't this stock. I can't remember, but just be wary of that. I'm sorry, I blew that one. I wrote down the wrong stock acronym. I'll figure it out 2 seconds after we shut this thing down. Starbucks out at what price and out before the report? Absolutely. So let's go back to Starbucks real quick. Finish up that thought. All right. So Starbucks, we were not looking at the July. We were doing the, what did we end up doing? These, bought these, and then did the $10 wide, right? Knowing that one. So the out, great call, because I didn't cover this on the other ones. So our max profit, let's just say it's $6, right? I'm going to have to pay up to get the $6 just to make math easy, right? I don't even think we need to bring this up. But our max loss is that $6. That's the most we can lose. Our max profit is the width of the strikes minus the debit paid. So $10 wide minus the $6 is $4. So our max profit is $4. What are we willing to take? If it's $4, I'm willing to take, $4, I'm willing to take 50% of that. So I'm going to be out when this increases by $2. So I'm out at $8. And some of you like to put in the GTCs, put that in right away. As soon as you put the order in and get filled, put in that GTC, okay? And know to get out at $8, which is probably where I write that down on my piece of paper. I'm getting out of this strategy when it hits $8. That makes sense? And if this market goes, now if it goes tomorrow or the next day, or actually Monday, to my 52.5 strike, this is probably not going to be a winner, and I'd probably get out. But in a week, if it takes a week to get down there and it reaches my strike, I'm not going to probably be at max profit, even though it's covered the distance of this width. But I will more than likely be at my 50% of max profit, okay? Therefore, that's when I get out. That also keeps you from having that risk of having an in-the-money option, right? If our 52.5 put goes in the money, we might get put that stock. Now, we have defined risk. We've got that long duration one, so we're not too worried about it. Although then you got to pay extra commissions and stuff, which isn't fun. But if we come up in the next week or so and hit that, you're going to be very close to that 50% of max profit. And that's another reason why I'm not going to ride this into the sunset. Probabilities weren't in my favor to get there necessarily all the way down there, especially this fast, then I'm going to take that off immediately. As soon as the market comes down, hits that 52.5, that's my target on it. That's where I'm getting out. All right. And you can use other things like Fibonacci, another one, because I vetted this one earlier, even though one of you guys picked it out. My support is slightly above with this Fibonacci where my short strike is. So I've got a couple of supports to hit before I come to mine. And it's also going to be a 52-week low. Some people might be like, well, you think it's going to go lower than the 52-week low? Well, it may very well if they keep having bad press. And, heading into this, people start saying there's not very many people buying Starbucks, but they're packed, then, that's not good for Starbucks, right? That makes sense for everybody? Make sure you go with that 50% of max profit to get out, because that increases your probabilities of success. And get out, move on to the next trade. Allocate that money again somewhere else. It's going to take a lot longer to get that extra $2 than it took you to get the first $2. All right? And it'll probably be a lot easier to get another $2 somewhere else than to ride that one out, right? It'll be a lot less headache, believe me. All right. All right, that's about it. Other than, one final thing. You guys, especially for you guys that are attending a lot of my webinars, this is a great options course. You guys should really take advantage of it for 36 bucks. And if you are a savvy trader, you've been around the block a lot, and you watch my webinar and you took anything away from it that you didn't know before, maybe even if it was that floor trader hack, to look over at the corresponding call to see what the put extrinsic value is. Those little things that are going to make your day go smoother. It's going to open up some bandwidth for you guys that said that, hey, I don't have it at the end of the day like myself. Think about it. If I had to go through and figure out what the break even was on everything and what the intrinsic value and extrinsic value of all these options were that I was going through all day long in my head, I would be more brain mush than I already am. So all of these little shortcuts will speed up the process in allocating your money, because you're going to get to the end result faster, which time is money. So everything I teach is to try and save you guys anguish and increase your probabilities of success. I use Fibonacci, I use technical supports and stuff like that. I know for a fact they aren't the end all be all, right? You guys know it goes down to a Fibonacci. It doesn't always act as support. Sometimes it blows right through it, right? It does help. It helps increase your probabilities of success. But just knowing your options education from Google isn't going to make you a successful options trader. You have to know how to take the options, increase your probabilities of success. You have to know when you can be buying options and when you can be selling options. There are different times to do that. It's really important, extremely important, to follow the rules that I set out in all of these webinars. And, you guys, one thing I always say, the only thing you can do to really make yourself a better trader is to constantly learn and stay mechanical. You can use technical analysis. You can use your options guide by Google, but it isn't necessarily going to make you successful. If you can increase your probabilities of success, you will be more successful. And that's how I teach. I correlated a lot to the casinos. Vegas didn't put up all those light bulbs because they were losing money. They put up all those light bulbs because they are making tons of money. And the reason why they're making money is because they know that the probabilities are in their favor. They aren't going to let you play a game where the probabilities are in your favor. The best odds in Vegas are on the coin toss of a football game, and that's 50-50, and they can't mess with that. That's your best odds. Other than that, the odds are in their favor, 60-40 in their favor. And they know that if they're getting beat on the probabilities, they continue to just work it, and the probabilities will come back in their favor. That's the same way we trade options. Increase the probabilities of success in your favor. Be the house. Don't be the guy that's on the floor just walking around not knowing that he should be splitting eights the guy's splitting eights or, splitting kings, something like that, splitting jacks, whatever, doing silly things that doesn't make sense. All right. Don't be that guy. So at the end of the day, what I mean is basically if you're trading technical analysis or even building strategies is not necessarily enough. The way to get ahead in this game is to trade the probabilities, to become more mechanical. And that's what I teach. Just like talking about little things, write the stuff down. That's how you be mechanical. That's how you're going to sleep at night, you guys. But anybody can teach you how to build this strategy. I'm not going to lie, but no one else is going to give you the ways to increase your probabilities, the strike location, where you should start really looking to narrow down your search rather than just willy-nilly picking strikes here and there. All right. These create a systematic process which will help you keep your powder dry too, all right? So we're offering this, guys, right now for the offer. We did do it for last week's as well, but if you're watching this webinar, you signed up for it, watching it on tape delay, take advantage of this. It's in the chat window. Sorry, I forgot to click on that. there's a link in the chat window. We've been going back and forth in the questions box, but over there in the chat window, I just sent it out to all you guys. It's part of that whole GoPro side thing. But these are great, you know, and what we do is we have a little check mark box here, and once you've watched them, you check it off, check it off, check it off. That way you can go, you know what, I want to see the income protection, which is a really the protection against rising interest rates, really big deal right now. That alone can save you the $36 in your portfolio. And when you see some of the charts of what raising interest rates does to your bond portfolio, it won't be the ugly stepchild in your trading regimen. It's going to be something that you really are going to be protecting. All right. Your trader tips plus details make the difference. Thank you, HH. I appreciate that. Is there a package with the Eric videos? Yeah, we have all kinds of packages. You know, talk to the guys and reach out to them. Say, hey, you know, I'm interested in this. You know, I want to learn more about you know, buying options or just selling options, or, you know, I want to just learn about certain aspect of options right now, maybe just the beginner options because I'm newer. Yes, we have packages for everybody. Just let us know, you know, talk to us, open conversation, and we can tailor something for you. So call us at 310-598-6677, or you can email us at trading@protraderstrategies.com. And also, guys, take it, you know, talk to them about getting the daily market commentaries too while you're on there, because I talk about every single trade I do, you guys, when I put them on, when I take them off. You know, I'm on it that day. And if I do an earnings trade, I tweet it out on Twitter. But I'm talking about those trades when I put them on, whether it's a winner or loser, how I'm being mechanical, what I'm doing to stay ahead of this, and how I'm playing it. If I put in a GTC, like you guys were talking about, I'll tell you, hey, I'm putting this in as a GTC. It's getting close, guys. So, you know, I'll let you know when I get hit. So I do all of those things in there. And we're offering this for you guys to, or that's not part, the market commentary is not part of this. You'll have to ask them about that package as well. But we're offering this package for you guys today. And if you're watching on tape delay, you're just going to have to pause it. It's not going to come up in any chat window mysteriously. You'll just have to pause and type this into your URL. All right, so if you guys learned anything today from me, you guys should really be trading with this knowledge. And what do you say? Go ahead and click on that link right over there in the window, and we'll get you guys set up. One last thing is I just want to say thank you for going a little bit the extra mile on this slightly longer than an hour webinar and sticking with me because I started a little bit later. But in later webinars, we're going to be drilling down on different option components and how I trade those options, trades I find, and when or where I find them appropriate, like that Starbucks trade. I might very well be putting that trade on tomorrow. I had a couple of other ones that I vetted that I didn't go over, like Verizon, Lowe's. So I'm going to be looking at those as well. So check out the market commentary for what I do there. All right. You, like I said, you can reach out to us 310-598-6677 or email us at trading@protraderstrategies.com. Again, this is a link. If you're watching it on delay, you'll have to pause and hold off. But like I said, this is over 10 hours, you guys. Over 10 hours. I know these videos are, and they're well over 10 hours for $36. That's a great deal. All right. That's all I got for you guys today. If you can't take that, take it easy. And I see a couple questions popped up here a little bit late, so I'll go over those. I don't want to send you guys off without having all your answers or your questions answered. Can we scan for this? Bandu, I actually have a short little thing that you can scan for high volatility. But the problem with high volatility is every stock has its own volatility, right? So like Tesla might be a 40 vol and Apple might be a 20 vol, but the scan is only going to give you those really high vol stocks. And that doesn't, just by looking at the vol, it doesn't give you the full picture. It doesn't tell you if it's high vol for itself, right? And that's really what we're looking for. is high vol for itself. So unfortunately, you know, I put it up over there on my watch list, and that's not unfortunate. I put it up over there in my watch list, the IV percent. I kind of shoot for those IV percent. So I'm looking at the ones that are around the 30. And then I just have to go into the option montage to figure out whether or not those are a difference. Thank you, Ted. Appreciate the kind words. Couldn't make the webinar just a few minutes ago. What? No, I almost started this late. No, I didn't. PW, I'm kidding. Yes, we will be sending out the recording. And one thing I say, watch, if you aren't familiar with this, watch it once and then like wait a day and watch it again. It'll really make it sink in for you. Yeah, so basically if the break even is higher than the underlying, we have a higher probability of success. Yes. And then when the move goes lower, we profit. Absolutely. And, you know, I mean, it's a comfort thing to know that you're already in the money, kind of, right? Starbucks, out at what price and out before the report? I would be out if it hits the 52.5 strike this month or in the month that is expiring. That's where I'd be getting out. And if the going into that earnings, the front month is most likely already expired, I'm going to take it off for whatever profit I can get. And if I'm, you know, even if it's slightly losing at that point, you know, I'll probably get out of it. If it's very close to a full loser, I'm going to roll the dice on it and let it ride out. It depends on how you trade. If you have less risk tolerance, then, you know, you could say, you know, I'm going to take, if I lose 50% the value of this underlying. So if I paid $7.50 when it's trading $3.75, I'm out no matter what. You could do it on a time stop if it's not starting to work for me in a week, but stay consistent, you guys. You know, try it and see where your comfort is. Stay consistent with it though. That's the way you're going to beat the probabilities. If you're sometimes doing it, sometimes not, the probabilities are probably not going to work for you. Does that answer your question there? Yeah, the link. No, you don't have to type this into your URL. You can hit on the link over there in the chat window. All right. You guys have a great night, and that's all I got. Other than it, take it easy.